Hi everyone, and welcome to Who Moved My Investment Portfolio. Joining us today is Christophe, the head of Discretionary Portfolio Management team at DBS. We look forward to hearing his views on building and monitoring diversified investment portfolios.
Hello Robin, it's a pleasure to be here. I hope what I will share today will be of help to those starting to invest or already active.
Let's start with our investment views for the second quarter of 2024. Where are the opportunities, Christophe?
Well, I've been watching this series and what I have to say is very consistent with what you and Alvin shared in the last video. In the current environment, bonds are still preferred over equities.
But there are some bright sparks for the latter?
That's right. Within equities, we continue to favor US as well as Asia ex-Japan. That said, since February, the performance of Asia equity has really rolled back to life.
Yes, absolutely. Since February, Asia ex-Japan equities have returned 7.3%, led by China with an 8.5% gain. Here are three factors which suggest there might be more to come. First, rising expectations of policy support with encouraging statement from China's central bank and finance ministry. Second, attractive valuations. China is trading at 40% discount to global equities, and this suggests that a lot of downside has already been priced in. Third, fund managers are mostly underweight on Asia ex-Japan, which suggests that a shift in sentiment will drive more investment into the Chinese market.
That's right. Despite high interest rates, US domestic spending and consumption remains supported by a strong job market. Our view is that the rally is broadening beyond tech to other sectors like healthcare and energy. So Robin, bonds have been seeing good fund flows momentum. How would you invest?
The expected rate cuts are positive for bond prices. Even if rate cut expectations do not change from here, we are still accruing interest of 5% per annum from investment-grade credit.
The risk to this outlook is stickier than expected inflation and a reversal of rate cut expectations.
Investors looking to navigate through these very different scenarios can consider investment-grade bonds with a short duration profile of 3 to 5 years. Now, this can be expressed through short-duration bond funds or DigiPortfolio save-up. Christophe, let's talk about your day job, portfolio investing. What is it, and why should we do it?
Quite simply to me, is looking at and managing your investment as a whole rather than a standalone holding or one-off transaction you make. That way, you can see how different building blocks correlate or interact in driving returns as well as volatility. The fundamental reason for investing via a portfolio approach is diversification. At any one time, diversified portfolio of different building blocks offer multiple sources of return, and during volatile markets, diversification helps to cushion against outsized drawdowns. For example, when we have spoken about how Asia ex-Japan equities have had a few negative years in a row, an investor who is invested in only Asia ex-Japan equities in 2023 would have missed out on the US S&P 500 returning 26%. On a broader basis, bond and equity performance tend to have a low correlation. This means that equities and bonds typically do not go up or down in tandem.
You mentioned the 2023 example of US equities going up 26%. Would I not be better off investing in just US equities?
Well, that is not wrong, but what I will say is that no one has a crystal ball to know how things are going to play out. There is quite a bit of research available online to suggest that timing the market is extremely challenging, even if it is your day job to monitor markets.
That's right. Just look at the S&P over the past 2 decades. The best performing days has occurred close to the worst ones, and missing them will significantly impact your annualized returns.
Yeah, for most investors, the key objective is to have consistent returns relative to the broader market, and while diversified portfolio will likely never be at the top in any given year, it is unlikely to be at the bottom either.
These are good insights. Now, a common question that our readers of investment publications ask: what does it mean to overweight or underweight the building blocks?
Based on your profile, or what we call risk appetite, there is always a starting point or a neutral point. For someone who is more balanced, if there was $100 to invest, you may put 50 into bonds and 50 into equities. Within the $50 in equities, it may be $25 in the US equities, 10 in Europe, 15 in Asia. Therefore, if I'm overweight bonds, it just means that I will put more into bonds, let's say $55 for example, and correspondingly reduce my equity to 45. Within equities, if I'm overweight US equities and underweight European equities, I will add to US equities and reduce the amount allocated to European equities.
Retirement planning has been in focus not just in Singapore but in the US as well. Life expectancy is going up, which means that people are living longer, and one's retirement nest egg will need to last longer. In Singapore, it's 81 for males and 85 for females. How are you handling your own retirement portfolio?
The key to me is to start planning early and leverage on the long runway to participate in market and grow your portfolio. Markets never move in a straight line, but long runway helps as it allows time for the portfolio to recover from market shocks that may come along the way. Hopefully this does not reveal my age, but when I started first working, I did not have as many options to automate dollar cost averaging as we do today. Investors should take advantage of this automation to conveniently start the habit of smaller bite-sized, regular top-ups to your portfolio. As they say, it isn't about timing the market, but the time in the market matters. I practice what I preach, and my investment portfolio is globally well diversified with a strong core as well as smaller satellite plays. The heavier allocation I have to my core offers me the confidence that the overall portfolio is going to be resilient, as the goal is to stay invested for the long term.
Well said, Christophe. That's all the time we have today, and I hope you found the tips useful for your own investment journey. Until next quarter, bye for now.
Bye.
Stay updated with weekly insights from DBS.